Welcome to the Deep Dive. Today, we're zeroing in on a really important Q3 2025 earnings call. It's for a key player in that high-end EV space. And this quarter, wow, it presents one of the most, let's say, compelling contradictions we've looked at all year. You've got this massive, almost unbelievable operational growth story, right? But it's running headlong into, well, a deepening, record-setting financial loss. It's quite the picture.
That's the core tension, isn't it? Management was effectively forced to sort of rip up the rule book midway through the quarter. They had to pivot their entire capital allocation strategy, really, just to make sure the company could keep the lights on, keep building cars, keep developing those future platforms. So for you listening in, our objective today is pretty simple. Let's analyze that shocking financial hemorrhage, assess the unexpected supply chain and leadership drama, and then figure out if these massive strategic moves they're making, into autonomy, robo-taxis, are they a bridge to profitability? Or maybe just an incredibly expensive delay tactic?
Okay, let's dive into the hard numbers first. The initial results snapshot, it was a bit mixed, wasn't it? And it ultimately pushed the market reaction more towards skepticism. Revenue came in at $336.6 million. Now, that's a very impressive 68% year-over-year climb. It shows genuine demand, genuine scaling.
Yeah, that growth is real.
But it still managed to narrowly miss the street consensus expectations. Fell short by roughly, 3 to 5%?
That's right. And, when you're scaling like they are, missing revenue targets by any margin, well, it creates headaches, definitely. But operationally, you have to give them credit. They hit some genuine milestones.
Yeah.
Deliveries clocked in at 4,078 vehicles.
Seventh straight record quarter for deliveries. I saw that.
Exactly. Seventh consecutive record. Production was slightly lower, 3,891 vehicles built. Plus, they completed over 1,000 units that are destined for final assembly over in Saudi Arabia. So the production story is one of sustained growth, even if it was, maybe slightly hampered.
Okay, but that growth, it feels overshadowed by the bottom line. And this is where things get genuinely frightening. The non-GAAP adjusted EPS. It came in at a staggering loss of $2.65 per share.
Oof. Yeah.
And analysts were already bracing for a bad quarter, right?
Yeah.
They were modeling losses somewhere between $2.35 and $2.35.
Yeah, right.
So we're talking about a loss that's 15, maybe 20% worse than those already pretty conservative estimates. For our listeners, why is that specific metric, the non-GAAP adjusted EPS, missing so badly? What does that tell us?
Yeah, that's the ultimate red flag, really. Non-GAAP is essentially the company's preferred way of looking at things, right? It excludes certain one-time costs, non-cash expenses. But even with those things stripped out, the miss signals that the immense costs of scaling, R&D, tooling up for the Gravity SUV, those huge initial fixed costs, they are just dramatically outpacing the actual revenue coming in from selling cars.
The sheer magnitude of that miss shows that every single car they sold this quarter cost them significantly more to produce than anyone, including them probably, anticipated. Which brings us directly to the burn rate. Okay, this is where the sheer capital requirements become crystal clear. Let's talk free cash flow, FCF. It was negative $955 million for the quarter. Just let that sink in.
Almost $1 billion.
Almost $1 billion. To put that in simple terms, FCF shows if a company has money left after paying for daily operations and all those capital investments. A number like negative $955 million means they're spending nearly $1 billion more than they bring in every 90 days.
It's an accelerating hemorrhage. And that FCF burn, it actually worsened significantly compared to Q3 last year. That was negative $623 million back then?
Right.
So yeah, it underscores the heavy capital commitment needed to go from being a boutique maker to a high volume player launching a massive new product like the Gravity SUV. You are literally spending today what you hope to earn years down the road. It's a huge gamble.
So if the ship is taking on water that fast, where's the lifeline? This brings us to the balance sheet anchor, and this was really the biggest headline from the call, wasn't it?
Absolutely.
They ended the quarter with $4.2 billion in liquidity. Now, in normal times, that sounds like plenty.
Right.
But given that FCF burn, that $4.2 billion could vanish in, just over a year at this rate?
Precisely. And that's why the market was instantly focused on the Public Investment Fund, the PIF, intervention. The PIF upsized its undrawn delayed draw term loan. It went from $750 million up to approximately $2 billion.
Wow.
And that crucial maneuver immediately boosted their pro forma liquidity, the sort of what-if liquidity, to roughly $5.5 billion.
Okay, hold on. $2 billion from the PIF, that's huge. But isn't that just, kicking the can down the road? Because they still had to announce after the quarter raising another $875 million through those 7% convertible senior notes due 2031. So the PIF gives them runway, sure, but raising convertible debt like that, it kind of screams desperation, doesn't it? Not exactly stability.
That's a critical distinction you've hit upon there. It's subtle, but important. The key insight isn't just the PIF loan amount itself, okay? It's that management successfully leveraged that sovereign backing into an 8-month runway extension. Ah, okay.
The time.
Exactly, the time. They now expect this liquidity to last into the first half of 2027. That stretches the previous guidance, which was only the second half of 2026. Now, the convertible notes, yeah, they absolutely confirm the market is right to worry about dilution risk, no question. But that PIF lifeline bought them the only thing that really matters right now. Time. Time to execute.
Time to execute.
Yeah.
But they're facing some serious operational friction, aren't they? Let's shift gears to those execution challenges. The first major fallout from these issues was the production cut. They trimmed the 2025 production forecast down to approximately 18,000 vehicles. That's down from the previous range of 18 to 20K.
Yeah, and this is where you see the operational triage happening in real time. They had a whole laundry list of setbacks, some macroeconomic, some logistical. They cited those persistent industry-wide chip shortages, still a problem, rare earth constraints, and then the really unexpected factor, that critical aluminum supplier fire.
Right, I remember hearing about that.
Yeah, that apparently temporarily forced them to adjust their production mix and volume quite significantly. So they're cutting production, which, okay, saves cash in the short term.
But doesn't that fundamentally undermine the scale they desperately need for long-term viability, cutting back when you need to ramp up?
It absolutely creates a strategic dilemma. But management is trying to signal they're in control through these internal shakeups. We saw a pretty significant organizational overhaul, including the departure of the longtime chief engineer, and then new senior VPs for engineering and revenue were brought in.
Right.
These are classic high-stakes moves, right? Designed to show the market, hey, we're serious about streamlining processes, accelerating decision-making, enhancing accountability, especially when scaling hits this kind of severe turbulence.
And does that streamlining lead anywhere positive on the product side?
Well, that leads directly to the good news, actually, on the product roadmap. The development of that crucial high-volume, mid-size EV platform, it remains scheduled for the start of production SOP by late 2026.
Okay, still on track then.
Still on track. And what's fascinating here, and this is maybe a glimmer of hope, is that management reported very favorable bill of material, or BEAM, cost performance on that mid-size platform already.
Okay, but why does a favorable beam cost on a car that's still, 2 years away from production? Why does that matter right now with all this burning cash?
Because it's the existential game changer. It really is. The lower the beam cost, the higher the potential margin when that car finally launches. That's their path to profitability on volume. Plus, they also mentioned that the supplier relief and the cost leverage they gained working on the mid-size program are now sort of bleeding over, extending to the current Air and the upcoming Gravity models.
Okay, so benefits sooner rather than later.
Potentially, yes. It means the intense pressure from that, negative 213% adjusted EBITDA margin, that might start to ease sooner than we previously thought. It suggests they can manufacture efficiently, even if the current scale is still absolutely punishing their finances.
Okay, so let's recap. We've got the PIF bridge secured, buying time. Operational restructuring is underway to tighten things up. And future profitability prospects are maybe looking a bit better thanks to those BOM cost efficiencies down the line. Now let's analyze those bold strategic ecosystem moves. The ones designed to shift the business model away from just burning cash on manufacturing towards being more of a technology and platform player.
Right, and this is where they seem to be trying to be more capital efficient, leveraging partnerships instead of just spending their own dwindling cash. First, there's the collaboration with NVIDIA. This is aimed squarely at integrating level 4 autonomy capabilities into their consumer vehicles.
Level 4, okay.
And they explicitly frame this as a way to avoid the billions that some competitors have spent trying to develop everything, software and hardware, completely in-house. They're aiming for a technology lead without that massive CapEx drain that, frankly, exacerbated their FCF problem.
Makes sense. And then the really high volume play is that robo-taxi strategy, right? That seems critical for providing a B2B revenue stream at scale.
Absolutely critical. They confirmed the Uber-Nuro partnership is moving forward. The first engineering vehicles based on Lucid platforms have already been delivered to Nuro, and Uber's plan is for an exclusive rollout using the Lucid Gravity SUV as the base for their robotaxis, starting in the San Francisco Bay Area in 2026.
And the scale there.
The target is massive, 20,000 plus vehicles over 6 years. That fundamentally shifts the volume conversation for Lucid, moving beyond just luxury consumer sales.
Yeah, that's a completely different business model almost.
It moves them into a high-margin services and fleet model, potentially. That could offer far better returns than just relying solely on individual luxury car sales. Furthermore, looking shorter term, management forecasts significant delivery growth coming in Q4. They confirmed the Gravity SUV is expected to account for the majority of Q4 production volume.
So the ramp is happening now.
The ramp is happening. And interestingly, they noted that their October deliveries and market share actually increased despite a broader industry slowdown after some of those U.S. tax credits expired. That suggests their premium niche might be somewhat insulated, at least for now.
And we can't forget the underlying foundation here, that huge arrangement with the Saudi government.
Yeah.
50,000 plus vehicles.
That's the bedrock. Management confirmed that higher delivery volumes against that specific contract are expected as Gravity ramps up, and especially once the midsize platform launches in 2026. That contract really underpins a lot of their future volume targets.
Okay, but if we step back and look at the market reaction, just sort of the stock performance over the last year, it tells a bit of a cautionary tale, doesn't it?
It really does. The stock has significantly underperformed the broader EV sector, and that suggests the market is still squarely focused on execution risk and, yes, dilution risk, regardless of that PIF safety net. The strategy sounds plausible, right? Pivot to tech, leverage partnerships, secure sovereign backing, improve costs. But the market needs to see flawless execution to really believe in that path to profitability. The trust isn't quite there yet.
Okay, now let's transition to our segment where we kick around some ideas. High risk, high reward possibilities derive purely from this data. And let's be absolutely clear, this is just a thought exercise. This is not financial advice.
Right. Not advice. But the key realization here, the thing that enables this kind of thinking, is that new runway. The PIF intervention pushed the immediate risk of, well, capital failure out to the first half of 2027. That runway, that extra time, it acts as a critical bridge, a bridge to two specific, potentially very high-impact events. First, the stabilization of the Gravity production ramp, getting that humming along. And second, even more critically, the launch of that mid-size platform. Both of those are slated for late 2026.
Okay, so you have this window of opportunity now where the risk of immediate default or running out of cash is drastically reduced. And that allows investors, theoretically, to position ahead of those big product cycle catalysts.
Precisely. So the outrageous but plausible trade idea, it's predicated on the belief that these strategic moves, the robo-taxes, the cost savings, can eventually overcome the current manufacturing cash drag. So what we propose thinking about is maybe a long-dated, deep out-of-the-money call option spread.
Okay, targeting an expiry that captures those late 2026 catalysts, stretching maybe into early 2027 to align with that liquidity runway.
Absolutely. Targeting late 2026 or maybe early 2027 expiry. It limits your upfront capital exposure, right? While maximizing the potential upside, the leverage. You are essentially betting that the company successfully executes on three key fronts before that new liquidity runs out. One,
What?
the 20,000 plus robo-taxi fleet deployment actually starts happening. Two, the Gravity ramp stabilizes and contributes positively. And three, they realize those favorable bill of material cost improvements on the midsize vehicle, making it profitable at scale.
Got it.
It's a pure high leverage bet, essentially, on that PIF bridge, holding just long enough for scale and margin improvements to finally kick in and change the narrative.
A compelling analysis.
Yeah.
Certainly high risk, as you say. Okay, that brings us towards the end of this deep dive. The core tension, it remains undeniable, doesn't it? You have the strategy to become a technology and platform player. It seems well-defined. It's backed by substantial sovereign funding.
Yep.
But the pressure to convert that operational progress, like the Gravity ramp and BOM improvements, into a drastically reduced cash burn rate before that first half 2027 runway ends, well, that pressure is existential.
It absolutely is. And that leads us to the final, maybe provocative thought for you, the listener, to consider. Given those favorable cost efficiencies they claim they're achieving on the midsize platform's bill of materials, how aggressively must the company lean into price competition in 2027? They're positioning themselves for scale, clearly. But with overall EV demand maybe slowing and the end of certain subsidies, could aggressive pricing be the only way for a premium brand like Lucid to truly capitalize on that new platform's better cost structure and grab market share?
A fascinating dilemma indeed, especially for a brand that's built its image entirely on luxury and premium pricing. Well, thank you for joining us for this analysis. As always, we strongly encourage you to perform your own research and due diligence based on these facts and figures. Good luck out there.